The S&P 500 is trading near the 7,400 level, but technical flow models show we are entering a zone of asymmetric downside risk. According to the Goldman Sachs CTA model, systematic trend followers have exhausted their buying momentum. The model identifies 7,322 as the critical short-term trigger level. Because this level is closely aligned with the rising 50-day moving average, a drop below it could cause systematic funds to immediately begin cutting their long positions. If the S&P 500 breaks below that 7,322 support level, it could trigger a wave of programmatic selling. The Goldman Sachs model suggests that breaching this floor would force CTA programs to stop out of longs and potentially flip short, releasing up to $46.7 billion in automated selling pressure. In a consolidated market, this scale of programmatic flow can easily trigger a cascade of long liquidations. This technical caution aligns with a broader shift in institutional positioning. The latest Bank of America Global Fund Manager survey shows that the recent bullish mania is beginning to cool. While managers remain net overweight on global stocks, they cut their net exposure by 12 percentage points in June. Notably, tech overweight positions were lowered to 26% as managers lock in profits ahead of the summer. Underlying this institutional caution is a quiet slowdown in global liquidity. The annualized rate of global liquidity expansion has dropped to just 3%, marking the slowest pace of growth since November 2025. When the global cash supply slows down, high multiple growth stocks lose the tailwinds that drove their spring rallies. A key driver of this liquidity slowdown is the contraction of central bank balance sheets, particularly in Asia. The People's Bank of China has shrunk its balance sheet by 13% on a 3-month annualized basis. This represents the sharpest contraction among major global central banks and highlights why the global liquidity environment is tightening. Even the market's primary leaders are reacting to these liquidity shifts. Nvidia recently executed a record $25 billion high-grade bond sale. While the order book was heavily oversubscribed at $85 billion, this massive corporate debt sale suggests that Nvidia is actively securing cash reserves and expanding its balance sheet, while credit markets remain highly receptive. This cash accumulation has drawn closer scrutiny to the circular financing structures within the AI ecosystem. Nvidia has established significant equity stakes in its own major customers, including Intel and Anthropic. This circular model, where a chip supplier funds its buyers, who then purchase its hardware, has drawn comparisons to historical infrastructure buildouts, like the early railroads and the internet. This capital-heavy transition is also visible at Microsoft. The company has guided its calendar year 2026 capital expenditures to an unprecedented $190 billion. This massive spending shift is transforming Microsoft from a capital-light software business into a capital-intensive utility provider, which changes how long-term cash flows must be modeled. This elevated capital spending is creating a massive depreciation wall. Microsoft's future depreciation and amortization costs could rise to $120 billion annually by 2028. This rising cost drag means that even if revenue continues to grow, free cash flow conversion will face significant headwind pressures. As capital spending rises, retail investors seeking high yields are encountering structural risks in options income vehicles. 0 days to expiry and at-the-money options ETFs like ZDTE and SDTY are suffering from NAV erosion. Because they write at-the-money options to fund high monthly payouts, they fail to capture index upside during bull runs while bearing full downside exposure. In half of 2026. This surge and reset pattern mirrors Tesla's 2010 public listing, which saw an initial 60% rally, followed by a rapid 50% correction before stabilizing. While tech and IPO names exhibit high volatility, corporate insiders in more traditional sectors are signaling confidence. Congressional disclosures show net buying of Parker Hannifin in the most recent quarter. The company has supported this insider interest by reporting adjusted operating margins of 26.7%, showing operational resilience. In the week ahead, the primary focus will be on the 50-day moving average test near 7,320 and whether the S&P 500 can hold its CTA trigger floor. We will also monitor global liquidity indicators, Nvidia's bond market reception, and upcoming central bank rate decisions to see if the market's sideways consolidation remains constructive.